Hey Team AAA, it's Melissa here, the owner of the AAA Financial Group and host of the Property, Ownership, Wealth and Everything Related, also known as the P.O.W.E.R podcast, where we chat about everything money, taking charge of your power, and we talk to special guests about how they got to where they are, the lessons they've learned and their insights on building a better future. Be sure to follow our socials at AAA Financial Group on Instagram, TikTok and YouTube, and visit our website at www.aamortgages.com.au. You can learn more about us there and potentially book in an appointment. So today I'm thrilled to welcome Ben Wise. He is a highly respected financial planner who is passionate about helping clients achieve long-term financial security and build wealth that aligns with their goals and values. From crafting tailored investment strategies to guiding clients through life's big financial decisions, Ben is on the front line of helping Australians turn uncertainty into confidence. Ben, welcome.
Thanks, Melissa. Great to be here.
Good to have you here. We've known each other a while.
We have.
We go a little bit back.
We do.
And we've recently ignited our friendship because we have businesses that align with each other.
We do, yeah. There's a lot of commonalities across your business and the business I operate in around helping our clients in a similar way. Obviously different solutions and strategies that we employ, but they are very complementary. So, no, really excited to be part of this and sort of talk to your network and let's have some fun.
Let's have some fun. So what I always ask people, because it's not just about what the service is and what we do in our career, is learning, and I'm sure some of our listeners would love to learn about how you became a financial planner and what your career journey has been to date.
Yeah, so I initially studied law and found it really, really boring.
I did not know that.
I don't know.
Did you finish it?
I didn't know.
I did.
Then I know you did. You tell me every time I see you.
I know. Never used it, but anyway.
But I found I was probably better with numbers and better with just being face to face with people. So I managed to sort of move across into a sort of pretty small practice here in Sydney initially, just doing sort of some back office work. This would be back in about 2002, 2003. So when we were young chicks back then. And from there sort of just progressed through, started seeing my own clients, building my own client base, getting a really good understanding about particularly what Australians like when they look and talk to advisors around what their wealth plans look like, what their goals and aspirations are.
Sure.
And it's been a really interesting journey. It's now sort of close to 20 years, or a little over 20 years of doing that.
Wow.
I know it makes me feel very old. Thanks for going, wow. That's really helpful. But yeah, look, I've had the opportunity to work with sort of a number of sort of banks and different sort of smaller firms over the years, just to sort of get a really wide breadth of different clientele and work with different sort of individuals, corporates and families around what they're looking to achieve. So no day's dull. Every client's different. It's always a bit of an adventure.
I get it. And so just from an educational point of view, if someone wanted to become a financial planner, what are the steps involved?
Yeah, so it's changed a lot since when I first did it. So I was lucky enough, I've got a bachelor's degree, which is relevant, but now you need that. You need to go and do a relevant bachelor's degree. Then you need to do specific, financial planning based subjects on top of that, which you can either do through some of the unis offered, or you can do it through sort of the online sort of Kaplan and things like that. Now you've got to do a professional year, which means you basically have to be mentored for 12 months by a more senior advisor. So I've sort of helped a couple of younger advisors through that over the years.
Nice.
It's a bit like, having your L plates on your car and then you get to your P plates and you go forward. So
a
lot of that just stems from some bad behaviour that came out years ago, which has been stamped out, which is great. It does mean it's a little longer of a journey to get to sort of seeing clients face to face by yourself, but I think there's a better grounding and a better training experience for advisors coming through that way. Getting the opportunity to spend time with one or two senior advisors really closely together, and obviously we invest our time and our financial resources into making that work, so it's really beneficial for both sides.
Understood. And I guess it would be like, you train to become a doctor, you don't just start operating on people straight away.
Sure, yeah, we'll compare ourselves to doctors,
I'll
probably go with surgeons.
I'm just saying, there's
exactly right. There is a sort of training program, and
exactly.
That sort of came back. If you sort of go back to when I studied this, the banks sort of monopolised what they called financial advice, which was really just selling superannuation insurance and investment products.
And banks still do that though, right?
Not really, no.
Oh, okay.
You've still got the private banks, which even they're sort of being wound down. CommBank just sold their private bank off. I think ANZ still has theirs, but Westpac has sort of got a small presence. But generally they all got rid of that because it really wasn't in the best interest of clients to have someone at a bank branch selling them, an insurance policy or a product over the counter. So that was all sort of stamped out, and as a part of that became the extra educational responsibilities, which I think are a good thing. It did weed a lot of people out, which is probably for the better. As we see in most industries, often there's a turning point where something changes how things have been done. And for us, it was sort of some of these practices that were pretty heavily exposed in the media at the time, and
Yes.
sort of through royal commissions and things, which not fun to go in if you're part of the industry, but I think we came out of it better.
Yeah.
Right, there's a lot less of us than there were,
Yes,
which sort of means obviously from our point of view there are a lot of clients out there still, a lot of individuals that need advice, and finding the right capacity to get in touch with all of those will be a problem for us going forward. But look, I trust that at some point the government will find some way to make that work. They are quite I guess keen on financial advice as helping Australians, so we'll see where that lands. But a lot of change in the 20 years that I've been doing it.
Yeah. So tell me then, if, as you just said before, if somebody doesn't have financial advice or a financial planner, let's just say it's a young family with 2 kids, and they're just, plodding along, they might have a mortgage, why would they seek out a financial planner, and what are the benefits? Yeah,
great question. One that we sort of deal with a lot. I think what I would say on that is for most people, just have a look online and have that appointment, because it doesn't cost you anything to meet with a financial planner to start with.
Okay.
And what I would say is, 99 out of 100 of us will say, look, I don't think there's a whole lot we can do for you, or it might be too expensive, and say, come back later on. What we would normally sit there is talk through previous experience with those clients and say, look, you've got 2 young children. If something happens to either of you, have you protected yourselves for that? Are you planning to put them through private schooling and things? Have you thought about how you're going to pay for that? Is the current house you're in the one you're going to be in forever? Do we need to start thinking about upsizing the house and things like that, and how you're going to afford to do that? So it's a really strategic approach to saying, what do you actually want to get out of the time and effort you put into working in your job, and the sacrifices you make by not being able to spend all the time with your kids and family, not being able to have all those holidays. What are your actual goals and aspirations that you want to work towards? So we can sit back and say, well, here's the roadmap to get there. Here's the things that can potentially go wrong. And that's really where the value of advice comes in, is that safety net that says, hey, if everything was perfect, your journey's going to be like that, but it's not. It's going to be like this and that. And where we come in is to say, well, when it is going like that, we're going to have that safety net underneath and the guidance and advice to say, look, it's okay, we can work through, we can adjust this, we can adjust that. So I would just say for those sort of young families, or anyone in particular, just have a look on the P.O.W.E.R website. Advisor ratings is another one. Find someone that's local to you, give them a call. Call a few. I always encourage my clients to see a couple of people, get a few opinions. I then say, give me some feedback if I'm not the one you're going with. And it might be because there was something that someone else said or sort of articulated better than I did, because we're never going to stop learning.
No.
I don't think in our space we have competitors. I suppose similar in your space, you don't necessarily have competitors as much as just colleagues in the industry that you're sort of working with, and occasionally you'll lose a client, or you'll misfire or something like that. So I think one of the big things I always do is get a couple of opinions. Please come back and let me know what you think. No obligation with those sort of first, second meetings. It's just sort of saying, hey, can we help you? Here's what the process looks like. Once we sort of go through that, we start to say, look, if you do want to go further, this is the overall process. This is when costs and things start to get discussed and put in front of clients. And what I find is if you articulate well enough what that actually goes towards, most clients will sit there and say, yes, that makes perfect sense, and we're happy to go ahead with that.
So there's the protective side, using insurances to, make sure that in that horrible event that something happens within your life, that your family or yourself is protected. And then there's the future planning. And when I first saw a financial planner, maybe 15 years ago, I was at that younger stage with kids, and they kind of said, oh, how much are you spending? And we went through all the cash flow components, and I kind of was like, yeah, okay, cool. Put some insurances in place, which are still there, which hopefully you can do something about very soon. But as I got older and like our careers progressed, it needs to be updated, and now that cash flow planning has taken on a completely different dimension. And then there's a lot of people that, are probably had a career for 30, 40 years, and they're thinking, now what do I do? So perhaps if you could give an example of that kind of experience. Maybe the kids are nearly finished school, maybe they've got 1 or 2 or 3 properties. How can you assist?
Yeah, definitely. I think it's a really great question. I'll touch on your first point there around, a lot of us do these things when we're younger because maybe our employer had a relationship with a planning group and they came in and encouraged you to do it, or it was through your employee's superannuation. So it sort of sits in the background, and then it gets to a point, as you've said, where things change. The family expands, the property portfolio expands, the asset base expands, the cash flow position changes. It's a really good trigger point to come in and say, that's great. But, particularly with people that own a lot of properties and are sort of getting that point of saying, well, kids are out of home now, I'm going to cut back on work. That's great. Do you have enough income coming in from that portfolio of assets, whether it's properties or anything else, to keep you in the current state of living that you're accustomed to and that you want to have? Are you planning to do sort of things you haven't been able to do? I always say to every client, retirement's different for everyone else, and I don't actually like retirement. I like post-employment life. Because retirement at 65 means you could have 30 more years of doing whatever it is you want to do. And you would have sacrificed. We're living longer and longer. And that's only going to keep going. So I always say to clients, think about the things that you haven't had the chance to do. It might be something of saying, I want to take up golf, I want to take up knitting, I want to take whatever it is.
Travel's
a big one.
Yeah.
But what I also find is clients always overestimate how much they're going to spend in that first few years.
Yeah.
Because they're not coming into the city every day and having to worry about getting the Opal card back and forward for work and things, and buying lunch at the canteens here, which is getting more and more expensive every day. So they actually end up saving more than they realise.
Yeah.
Plus the reality kicks in that you don't have a steady paycheck every month from your employer. It's from your own asset base, whether it's your asset portfolio. So property obviously is a great example of assets that Australians have made huge amounts of money on and is very successful. Whether it's your superannuation funds, which you can then start to access and draw an income from in a tax effective manner. So it's really sitting down there with those older clients and saying, let's have a look at exactly where everything is. Put everything on the table in front of us. We literally whiteboard it out. Sit there and go, let's talk about all the assets you've got, all the income sources, everything else. Okay, if that all stopped today, the income from employment, what happens to everything else? And particularly a lot of older Australians are still holding a lot more debt than they probably expected to as they get to retirement, just because a lot of people have refinanced through their home and bought other assets and things. So we sit there and say, that's fantastic. There's great tax advantages to that if you're getting a taxable income, and it justifies doing that. So it's a really different framing of a conversation around really going hard on what's your cash flow needs, what do you actually need? If you stop working today, what do you need every month coming in? What's the nice to haves? What's the must haves? And sitting there and working out, okay, for the first 3 years, you might need an extra $50,000 a year to go travelling. You might want to buy that last new car that you're ever going to buy. All these sort of things. Doesn't matter what those goals are. We can sit there and then say, look, it's achievable, or we need to make some drastic changes to get there. And if the changes are too drastic, we need to reframe what the goals are. Which most clients, I think, when you go through that process quite methodically, understand that life isn't perfect. You're not going to get everything you want. Fortunately for a lot of clients that have taken advantage of the superannuation system, build a nice property, an asset portfolio, they're actually quite comfortable in retirement. Particularly most of the clients that we see in the Sydney CBD area. But I always say to people, the younger you start doing some of these things, the better the outcome will be for you.
And it becomes like part of your thinking process. It's not just we're in a wheel going around and round and round, and just each week, each month, each year, and then all of a sudden it's years, and it's like, well, what are we actually doing? What do we want?
You want to move from treading water to floating, really. You want to just be comfortable.
Floating on a pool.
I know what your lifestyle's like, so
My ideal lifestyle.
Yes, sorry.
Not there yet. So then tell me, once you've given advice, no matter what stage of the life journey you're at, what's the touch base with a financial planner or with someone like you?
So it's at least annually. And then depending on sort of how high touch the client needs it to be, like if someone's got quite an aggressive savings plan goal, or they're building towards that first property, a lot of younger clients we're helping with cash flow modelling and things like that, it's going to be more regular than that. That's just a phone call, a quick email. And obviously with technology the way it is with Teams and Zoom now, it's probably one of the only good things COVID gave us was the ability to not have to sit there and say, can you meet me at 2:00 on a Tuesday in my office or your office? It can be, did you want to just do a quick call at 4:45 when you pick the kids up after school? And it might just be hey, how much have you put away this month? Great, that's where we thought we were going to be. It's a little bit less. Why? What happened? Oh, we had car rego. Things like that just pop up and we can factor in for.
So they need that
for a lot of clients, it's
advice.
Exactly right. And I think a lot of people just like that as a sounding board to say, hey, are we still on track? I always say to clients, call anytime. That's what we're here for. We have a team of people that work with us as well to help sort of triage some of that stuff and say, hey, you're just looking for an account balance, we can help you with that. Hey, you're looking for a more detailed discussion, we can book something in. So it's definitely at least annually, at a minimum with every client. And that's just the insurance clients too, to say, have you taken on more debt? Have you reduced your debt? Has there been any change in cash flow and income? Has there been any change anywhere else that we need to factor in? So no, we do like to do that at least once a year. And for a lot of clients, it's a lot more regular than that.
Okay, good. Because like I said, you're in the rat wheel, but then you don't want to be like, oh, I have to get in touch with them and tell them this. Like you kind of set them up for success, and then as needed you're there. But if it's to draw on a statement or what have you, you can assist that way. So then let's talk a bit about what you do, what I do, and the collaborative power of using, I guess, brokers, a financial planner, an accountant, and a lawyer. Let's use the example of a couple who you probably know that have bought a property in their self-managed super fund. How does this all work together? Because we are certainly seeing as a brokerage a large uptick in people purchasing in their self-managed super fund, whether it be residential or commercial. So
we're seeing the same. I think it sort of dropped off as a really popular strategy for a period of time, but I think particularly for people around our age, they're saying, hey, we've built a nice little super fund here between husband and wife or partner and partner. And they're saying, what can we do with it that's not as vanilla as what we're doing? And they want to use the leverage of debt, which obviously is where you guys come in there and help us with that and say, well, how do we do that? We then sit there and say, we need to set up this type of fund, which requires the involvement of an accountant and involves the involvement of myself to sit there and say, hey, These are the things you need to consider. Is it appropriate for you to do it? Does it make sense financially? Are you losing anything from your existing funds by doing this?
Yeah.
Once we're all comfortable, we sit there and do that. They come to you and say, hey, we've secured a property, or we're looking at something. You go away and obviously work out whether they can afford to do that. What it really does is it's exactly the same as if they were doing it in their own name, but they might not have the capacity to put out that amount of money on a next property while they're working and they're putting kids through school and paying off a mortgage.
Yes.
So it just allows them to use property as an asset class, which, contrary to popular opinion, as advisors, we actually love property as an asset class because A, we need one to live in, and B, while you're working and as an income's strong, you get those great tax advantages through negative gearing and the capital gains tax concessions when you sell, versus having some other assets which aren't as attractive from that point of view. The only difference is obviously the barrier to entry. If you want to buy a property in your own name here where we are in Sydney, that barrier keeps getting higher and higher every sort of month, not even every year anymore. So superannuation as an asset class to buy a property is becoming really popular again. Commercial property for sort of professionals. So I think we've got clients such as dentists, doctors, real estate agents and things that buy their commercial asset that they work out of in their super fund. So essentially they're paying rent to them, to their future selves, to the super fund. That's a really popular strategy as well that we see a lot of times.
We love that one.
I think it makes a lot of sense. Why pay someone else for the asset that you're using and you fit it out and you spend all this money on when you could technically be just paying your future self your retirement money?
Exactly.
And I think once that penny drops with those clients, they sit there and go, wow, wish we'd known about this years ago. Because obviously the property value's gone up between when they moved in and where we are today. So we're seeing a lot of that too.
And I think that's important for people to also understand is that when you go to service your home loan or additional investment properties in your personal names, you use that same debt and your living expenses to service the loan. But if you have over here a commercial property, say because you have a factory that you're currently renting and you purchase the factory and then the company pays rent to the self-managed super fund, you could have that debt over here at say $5 million, but that servicing in the self-managed super fund doesn't affect your personal servicing because the accountant is used in the SMSF to set up what is called a separate corporate entity. What happens is you put your superannuation into or use that as the deposit and then the rent will service the loan. So I think people don't really know about that. They don't really understand the tool. They think it's only for the wealthy, but certainly you could build up a 300,000-400,000 in a couple for super isn't unusual, and you can use that as a deposit.
I think that the other thing too is as your income increases, your compulsory super contributions from your employer increase as well.
Yeah.
So if
what's
you've got
the
them
rate
directed,
now?
12.
29%?
Yeah,
No, 12.
45%.
Feels a lot higher.
No, and it will continue to rise and to a point there. And obviously that's just to encourage people not to have to rely on sort of Centrelink and Social Security in the future.
Yes.
But what that means is if you're directing those contributions plus your rental, for a couple earning, a combined income of $250,000, that's what, $30,000 in contributions, plus possibly the same or more in rent. That's comfortably servicing that debt.
Absolutely.
And they're not having to do any more than what they're currently doing. Doesn't affect their personal cash flow.
No.
If in the event that they're slightly short, they may need to put some additional money in, but they're getting a tax deduction for that.
For that anyway.
So you're not putting $1 in and having to lose $1. You're actually losing less than that because of the tax deductibility of the super rule. So that's why we think as an asset class, it's really it's misunderstood by a lot of people because it is this big multi-trillion-dollar behemoth that just sits there and all you hear about is that the government wants to tax it more and they want to take more on this and this. But if you're using it effectively and you take the time to get to understand what your options are, it's not just for the wealthy.
No.
We've got a lot of clients that are now wealthy because they've used that as a strategy, and when they get to retirement, they can sell that asset potentially tax-free and then retire off the proceeds of that and draw a lovely income, have their holidays floating around a pool, drinking Mai Tais,
Yeah, pina colada.
So.
Yeah, there you go. But look, I think that just kind of one of my next questions was that, and this is, technically great conversation for someone who's thinking or doesn't really know or who's kind of like, oh, okay, maybe there is something else I could do. Maybe there is something in the future, and that, really it's not about just for the wealthy. Yeah. Certainly the wealthy people will have used it because they've probably created their wealth and spoken to financial planners over a long period of time. But for the average Joe Blow like us, we just want to, do the very best we can out of our personal situations. And if that is an opportunity to increase and create wealth, I think that's a good option for people.
Yeah. I do think, when we get a pay rise at work, we don't ring our accountant and ask what should we do. If we had a liquidity event where we owned a business and someone said, we're going to pay you X amount of million for it, your accountant's probably one of the first people you call after your family and say, hey, fantastic. Yeah. And that's where this structure and stuff starts.
How do I not pay so much tax?
Exactly right.
Yeah,
But it doesn't stop anyone else from having that phone call or saying, hey, should we be doing something differently than what we're currently doing?
Yeah.
It starts with a blank piece of paper, which said, what are you currently doing?
Yeah.
And I would like to say that 9 times out of 10 we can find 1 or 2 things that say, hey, if you tweak this slightly differently,
yes,
you'll have a better outcome. And
yeah,
you move from sort of being, we're not quite sure if we're going to be wealthy and successful in the future, to having that certainty that, okay, we know where we're going to end up. All things being equal, this is how our lives should look.
Yeah.
We should be comfortable.
Yeah.
We can retire at whatever age we want to. We'll have X amount of cash flow coming in. It's really just about managing those expectations too.
Yeah, and like that, just hearing that now, I'm like, oh, that would give me so much more peace of mind. Like just that there is a plan, and we know plans can change, but just kind of going, okay, yeah, look, there's something there that I'm working towards that, is, I'm going to be okay when I'm older, and it's a nice feeling.
Yeah, look, we have to call it a statement of advice, but we generally call it a financial roadmap. So there's a start and an end.
Yeah.
And in between, there's a whole lot of different ways you can sort of move around. It's a bit like a board game when you're a kid, snakes and ladders and all these sort of things. But we know where we start and we know where we want to get to. If we can articulate those 2 things, we can manage the rest. And again, it is about that peace of mind of saying, hey, look, we know life's not going to be perfect. We can't control what asset markets do, whether it's shares, property, or anything else. But we can control, how much money we're putting aside for this, whether we want to put our kids through public, private, independent, whatever we're doing, things like that we can control.
Yeah.
And from there we can start to roadmap out and say, well, this is what that's going to cost. This is the sacrifices you might need to make short term to get there.
Yeah.
But once you've done that and you've paid off all those things, you're going to have so much more disposable income coming in. You can catch up on what you weren't able to do because you were looking after your family and putting things like that together.
Got it. We really need to talk. Because I'm like, I really want to do all of that. And because I'm often, as a lot of people who are working all the time, and you're just in the moment, but it's kind of, as you say, as a business owner, you're working in the business, but what I really want to do is work on the business. And if people and families or any group of people wanted to think about how they can not just be working in their lives but on their lives, I think that financial roadmap would give them that trajectory to their.
Yeah, well, we're all busy enough.
Yeah, well, yeah, we try. Can't never be too busy, but we'll go from there. So look, let's switch it around because I think that was very sage and like really good advice and positive advice too,
It's the
right?
nicest thing you've ever said to me.
It's only been 30 odd years, there's still time. This is like some personal questions for you, some spitfire questions.
Okay.
And you just say the first thing that comes to your head, because I know you haven't read these show notes. What's the best money tip you've ever received?
Start early.
Okay. What's the most common money mistake you see?
People not taking simple advice. And I'll give you an example. So something like an offset account, which I'm sure you preach to all your clients when they're buying a property, their home. Just set the offset account, use that as your cash account, and then people set it up and don't use it. So something similar like that where there's a really basic strategy in front of you and you just ignore it.
Yeah. Where do you see the role of financial planners over the next 5 to 10 years?
I think it's only going to get bigger because we do have this huge transition of wealth still coming from a retiring generation to the next generation. A lot of the clients we're seeing now have been with us for years, and the parents are now saying, but we want to pass assets down to our children. So we're engaging with the second generation who are our age. They're not young kids. They're at a point where they're in a similar, I guess, life stage position.
Give me money.
Well, yeah, mum and dad are going to give us money. It might pay off the mortgage. It might do this and that. Yeah, it'd be lovely, wouldn't it? Might pay off the mortgage and do things like that. And then they sort of go, well, what should we do now? Because we're going to have X amount of money per month that we're not putting towards a mortgage, or should we maybe redraw against that and buy another asset, which is where we come to you and say, hey, let's all get on the same page here, get the dream team together and go, how do we do this? So, yeah, I think the role is going to be really, what's the word I'm looking for? Give me a second to come up with one. Transformative, yeah.
You started with T.
Yeah.
Prominent.
I think it's going to be about a transition of wealth, for want of a better term, of just moving from an older generation that have, they've all made a lot of money off their property and things like this. A lot of them have assets that they have to sell down. They're going to pass these down to their dependent or their children or whoever it is, who may not have ever had that amount of money in their pocket in their life. And I think those are the people who are going to be encouraged to say, well, have you spoken to someone about what you should do? Don't lose it all and don't be silly. Set yourself up because you've been given a gift and a windfall. You should take advantage of that.
Yeah, absolutely. Don't just fritter it away.
That's right.
And for our final question, what is one power quote or mantra you live by?
Yeah, I love this one from the Australian cricket team. I think it was Steve Water, Adam Gilchrist, where he said, attitudes are infectious, is yours worth catching?
Attitudes infectious, is yours worth catching? Well, I think yours definitely is.
Thank you.
Thank you very. Oh, it's the second nice thing.
I know.
There we go. We're
I don't want to say too much because you'll stop.
Yeah. But thank you so much.
No,
for your time,
absolute pleasure.
We've
Thank you so
shared
much.
Some valuable
A lot of fun.
insights, and I think whether you have a financial plan or you're thinking about one or you've had one in the past, it's definitely worth getting working on top of your life instead of in it.
Yep.
Even for those brief period of time that you have to concentrate and really think about what it is that you want. And thanks, Ben. That was really valuable.
Pleasure,
and we'll
so
add
much.
your contact details into our show notes.
Thank you very much.
Thank
Great fun.
you.
Thanks, guys.
Everyone. Bye. Well done.